Here's a weird truth. Being cautious can make you richer. Benjamin Graham, the teacher of Buffett and countless disciplined investors, spends these chapters showing that intelligent restraint, not bravado, is where most enduring gains come from. In this video, you'll learn the exact guardrails Graham recommends for someone who wants to protect capital and still own stocks. Plus, the no-nonsense rules for the investor who's willing to roll up their sleeves and hunt for bargains. Ready? Let's go. Chapters 5 and 6 move from general portfolio rules to actionable selection and avoidance guidelines. Chapter 5 is the defensive investor's playbook for owning common stocks, what kinds to choose and how to treat them. Chapter 6 is the enterprising investor's negative checklist, the things to avoid unless you truly understand what you're doing. Together they answer a core question: how do you hold stocks without becoming a speculator? The defensive investor wants two things: safety and freedom from bother. That means your stock choices should be designed to minimize risk, provide steady returns, and require little babysitting. Graham isn't looking for the hot pick. He's laying out filters that make a common stock holding behave more like a reliable asset in your core portfolio. Graham gives practical, measurable criteria for the defensive investor's stock list. Roughly translated into modern screening language, he wants companies that check boxes like large, well-established firms, not tiny speculative names. A long record of stable earnings and dividend payments. Moderate price relative to earnings or dividend yield, i.e., you're not paying a sky-high premium for future hope. Strong financial position. Reasonable debt levels and reliable financing. Diversification. Own a large number of these issues to avoid single-company risk. Graham values dividends and an earnings track record because they're objective evidence a company can generate cash, not just glossy forecasts or management slogans. Dividends provide a tangible return while you wait, and a stable earnings history reduces the chance that a company will collapse unexpectedly. For a defensive portfolio, that reliability matters more than a flashy growth story. Think of diversification as insurance you pay with a tiny trimming of upside. Owning many good companies reduces the odds that any single bankruptcy will wreck you. Graham recommends a sizable basket, not a tiny handful, because only a wide spread truly protects the defensive investor. Graham cautions defensive investors against chasing high-growth names, IPO mania, or companies that require faith in future potential rather than present strength. Those stories often look great in a bull market and catastrophic in a downturn. For the defensive investor, the opportunity cost of being wrong is simply too high. Graham's guidance is humble. Own enough different high-quality stocks so that a single company's failure won't matter. While he doesn't hand you a hard and fast modern ETF equivalent, the spirit is clear. Broad exposure through many issues, or a high-quality index fund, is perfectly suitable for the defensive investor. For many people, a straightforward index fund, or a diversified set of established dividend payers, achieves Graham's goals without extra work. Graham endorses methods that discipline buying, dollar-cost averaging, and periodic rebalancing. If you add to your stocks steadily, you avoid timing the market and buy more when prices fall. Rebalancing brings you back to your target allocation and forces you to sell high, buy low, mechanically. One of the few reliable ways to harvest market volatility. Although Graham wrote in a pre-index era, the defensive investor benefits from the modern equivalent, a low-cost index fund that captures a broad market. It ticks nearly all Graham's boxes: diversification, low maintenance, and capturing long-term returns without costly mistakes. He liked the idea of a permanent autopilot for those who want to say, "I don't know and I don't care" about short-term market guessing. If you want a quick, actionable screen for defensive stocks, Graham style: market cap, large companies, blue chips, positive earnings for the past 5 to 10 years, dividend-paying record, preferably consistent, reasonable payout ratio, and modest debt. Avoid recent IPOs or companies with volatile revenue. Graham's enterprising investor starts with the defensive base, a balanced mix of high-grade bonds and good stocks. The difference is that the enterprising investor may go off the beaten path, if there is a clear, well-reasoned justification. Chapter 6's value is in the negative rules, the lists of tempting things you should usually avoid unless you really know what you're doing. Graham says, leave second-grade bonds and inferior preferred stocks to the specialists, unless you can buy them at real bargains, typically large discounts. Think 30% plus below par for high-coupon issues. Why? Because their credit quality is questionable. They can and do default. Cheap offers potential reward, but only if the price reflects real risk. Graham is merciless about IPOs. He points out that many new issues are priced for excitement, not value. Insiders often exit early, and early buyers can get burned. His colorful shorthand for IPO fever still applies. Many IPOs are overpriced, hyped, and short-lived. The enterprising investor should treat most IPOs with deep skepticism. Convertible bonds and other hybrid securities may look attractive because of upside optionality, but Graham warns, these instruments can be complicated, illiquid, and tied to management's future actions. Only use them when you understand the conversion mechanics, the company's finances, and the downside exposure. Don't be dazzled by optionality alone. Special situations, liquidations, reorganizations, arbitrages, and similar events can offer outsized returns, but they demand skill, legal and accounting knowledge, and patience. Graham reminds the enterprising investor, these are not casual plays. If you're doing special situation investing, treat it like a job. Research deeply, quantify outcomes, and accept that many will fail. If you're buying lower quality bonds, buy at prices so low that the bond's prospective gain compensates for likely credit improvement, not just yield. Graham's math says you need a real margin of safety. Otherwise, the yield disguises capital at risk. One of Graham's recurring themes, match the strategy to your temperament and competence. If you don't enjoy digging into balance sheets, don't pretend you do. The enterprising approach is noble, but it requires time, humility, and acceptance of being wrong sometimes. If you can't live with those, stay defensive. Graham's text is full of examples. Companies that looked tempting and then imploded, or securities that seemed clever but hid risk. The modern equivalents are easy to spot. Heavily leveraged restructurings, momentum IPOs, or too good to be true bond yields. When the structure is complex and you can't explain the downside in one sentence, that's a red flag. 4 practical, implementable rules from chapters 5-6. For defensive investors, prefer large, dividend-paying companies with long earnings records and diversify widely, or use a broad index fund for the same effect. Follow simple screens, long earnings history, dividend consistency, reasonable price, moderate debt. These reduce the chance of catastrophic loss. Enterprising investors, avoid unless cheap. Don't buy second-grade bonds, preferreds, IPOs, or complex hybrids unless prices include a large margin of safety and you truly understand the downside. Which approach fits you, the defensive autopilot or the enterprising hunter? Tell me in the comments. And if you're enterprising, what's the last special situation you researched? I read and reply to the best insights. If you found this helpful, like and subscribe. Next video we'll build a sample defensive portfolio from scratch and show live rebalancing examples you can automate. Want a downloadable checklist of Graham's defensive stock filters and the enterprising negative list? Say checklist in the comments and I'll drop it in the description.